The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. We're going to give everybody just another minute or so to get on the call, and we will start our webinar. Those are give everybody one more minute before we start. Okay. Good afternoon, good morning, and welcome. Welcome to Establishing a Loan Policy for Your CDFI, sponsored by the CDFI Funds Capacity Building Initiative, the Carsey Institute, and NeighborWorks America. We will spend the next 90 minutes together going over key elements of loan policies. It's a lot of information to cover, and we have a full today webinar. So our format will be one requiring some focus and some patience. I will be presenting information, stopping for questions, which you will need to type in, and then I will do my best to answer those questions and then present again, stop for questions, and so forth. There are just too many of us on the webinar for a productive live discussion. So again, we encourage you to type in your questions at any time throughout the presentation. If your question is not answered, as part of the CDFI Funds Capacity Building Initiative, you will be able to follow up with key experts in the field after the webinar, in most cases at no cost. So don't worry if your questions don't all get answered today. They will get answered. At the end of the program today, we will give out the contact information for those experts. You will also receive the entire PowerPoint delivered today, which can serve as a reference document and includes that key information on how to get technical assistance. This is the first of several sessions that are being held over the next few months as part of the CDFI Fund's Capacity Building Initiative. If you happen to drop off the call today or have a problem with the technology, I encourage you to simply log back on. Today's session has 5 parts, and we're going to talk about those 5 parts right now. The first is the introduction, and then we'll spend a few minutes talking about the benefits of a loan policy. Then we will move into the 12 elements of a good loan policy. This is the heart of our presentation and is derived from information from the FDIC. We will also spend a few minutes after that going over lending control functions, and then we'll have conclusions. Again, we will be taking questions at different intervals throughout the webinar, so please feel free to type in your question at any time. With that, let me introduce myself. I'm Kristen Faust, Director of Lending and Network Services at Partners for the Common Good. We are a federally certified CDFI in existence for over a decade. And I have a long and varied background in community development lending, and finance, and it includes banking, CDFIs, and public sector experience. My picture is there for you to see, but I am not able to see all of you. So I would ask that you take the first of several polls today and take a minute and answer the question that we have, the first one of which is, are you a federally certified CDFI? The poll should be popping up on your screen, and if you could take a few seconds to answer that, and then I will report back the information as we gather it. From the original registration, it did look like we had a great mixture of small and large CDFIs, a few consultants, and some government folks. Okay, we'll just give you a few more seconds to do that poll. And I would like to move into the benefits of a loan policy. Why do we have loan policies? Well, if you are a federally, if you're a CDFI that is a bank or a credit union, you had to have loan policies to receive your charter. However, for most of us, the reasons to have loan policies are the following. First of all, it establishes authority, rules, and framework to operate and administer the loan portfolio effectively. It also helps us control our lending risk. It ultimately ensures the institution's stability and soundness. And if reviewed regularly by the board, and that is in italics because that's an important component, the policies will ensure that underwriting practices and loan documentation are in accord with the board's tolerance for risk. One of the things you need to know before you start writing your policies is, why are you writing them? Are you doing something different right now than what your policies say, and so you do need to make a change to your policies? Or do you need to change how you're doing things to make them more in accord with your policies? Are you a new CDFI who's writing them new? Are you revising policies? Are the current ones too stringent or too lenient or not detailed enough? These are all questions you need to be able to answer so that you can stay focused and understand what your objective is with the policies. And then you need to think about who your audience is. Is it your staff, the board, outside reviewers? Well, the answer is really, for loan policies, the audiences are all of the above. Let's move in to the 12 elements of a good loan policy. These 12 elements are derived from a publication by the FDIC, which is the entity that regulates banks. And while we are not all banks, the 12 that are delineated here are still true and important for us unregulated CDFIs as well as regulated CDFIs. It doesn't mean that you will only have 12 elements in your policies. Your policies may include many more elements. And at the end of the presentation, there are some sample table of contents which can serve as a resource guide for you. Another thing to note about these elements is that some are just 1 or 2 paragraphs, and others are very complex and might require a couple pages in your policies. Such as the one on loan workouts and delinquencies. So they are not all equal in importance or in size of in scope. The idea here, though, is, I'm sorry, let's stay on this slide. The idea here is, though, that this gives you a good outline, a good core skeleton to develop your policies. And the 12 policies are quickly, and then we'll move through them one by one. A clear mission statement, a specification of your lending authority, delineating the responsibilities for reporting loan information, describing your origination and underwriting criteria and process, documentation for a complete application and a complete credit file, and then who maintains those credit files, what your collateral guidelines are, what your loan rating and loss reserves policies are, how you set interest rates and fees, what your preferred upper limit for total loans outstanding and your concentration limits are, a description of your trade area, and 12 is how to detect, analyze, and work out problem loans. Okay, with that, well, let's get started. I'm going to walk through a couple of these elements and then I'll stop for questions. But again, you can type them in at any time. So the first element is a clear mission statement for the CDFI's loan portfolio. And this is just a great way to start your policy. So if somebody picks up the document from the outside and the first thing they read is what your policies are trying to achieve, or what your organization is trying to achieve. And here are 3 examples. This first example says, the Credit and Portfolio Management Policies Manual is intended to help staff and board make loans that meet the project-related credit needs of community development organizations in our town, while simultaneously meeting our obligations to investors for safety, liquidity, and social and financial returns. What I thought was interesting about this example, and all of these examples are pulled from actual loan policies of CDFIs, and these 2 paragraphs go together with this one. But I highlighted in this CDFI is saying right out front, look, we care a lot about the credit needs of our community, but we are also always having to balance our investors' needs. And they decided to put that up front. This next loan fund has the tolerance of regulated lenders. So the first sentence, it sets the stage that we are taking more risk than a regulated lender. And then it moves on to talk about how management of those risks is everybody's responsibility on the staff. A third example that I included here is a more standard example. Guidelines are designed to provide lenders with a description of the types of loans and underwriting criteria. But it also says these guidelines should be referenced and used in conjunction with the CDFI Loan Processing Handbook. That's the loan processing handbook that CDFI has. And I included this example because many loan funds will have loan policies, and then sometimes from the beginning and sometimes as they evolve, they will create their own loan processing handbook. One of the questions I just got is how often we update policies, and that relates to that statement about if your board reviews them regularly. A standard practice is to have loan policies reviewed annually, and often you will put a statement in your, and it's the segue is right there, you might put a statement in your policy that say that the policy should be reviewed annually by the board. What I want to say about that, though, is it doesn't mean that you have to change your policies every year. It means that your senior lender, your CEO, is going in and looking at the policies and saying, do we need to change anything? And this year might be a year where you go back to your board and say, we have reviewed the loan policies and we are recommending no changes. On the other hand, it might be a year where you realize you do want to make some changes. There's a new product, or you've tightened or loosened the underwriting criteria, or you're doing something a little different. You've changed your geographic scope. So that's an important thing to put in your policies. You also might want to have a statement in your policies about confidentiality, and just say, are these confidential? Some people are very proprietary about their loan policies. Another thing to consider is that I've seen CDFIs that talk about, are they guidelines or policies? And that the difference intended there is that a policy is strict. If we have a 1.20 debt coverage requirement, it's 1.20, and anything outside that is an exception. Whereas a guideline is that it's a guideline, but we're allowed to do something different than the guideline. It's just a guideline. The general quality of loans, you might put a statement in there about just generally we're looking for loans that meet these criteria, and how much detail you're going to put in your policies. Who you are on the loan policies. It can include your mission statement of the organization itself, but it's also specifically about your mission as it relates to the loans. All right, I'm going to move on to element number 2, but I would like to take a poll right now also to learn a little bit more about you again and just ask each of you, and we have 67 people on the call right now, what type of CDFI you're from. And we have some choices, I believe, about housing and business. And so if you could take a minute to open up that poll and click your answer, the one that best fits your organization, that would be great. We'll give you just a few seconds there. All right, and we'll keep that open for a few more seconds. And I'm going to move into element 2. Element 2 says you need to be specific about the lending authorities. Who has lending authority? Is it in the loan officers, the loan committees, and what is their lending authority? And this is an example, a couple of different examples for you. The first is from a large loan fund where they have a more complex system. And here they make loans over $1 million. They have relationships where they have multiple loans, perhaps over $1 million to one borrower. And so they show that if the loan's under $1 million and the total relationship exposure is under $2 million, then the chief credit officer can approve the loan. And our poll is closed, by the way, and we'll show those results in a few minutes. And you can see as you go down this chart, an example, if it's over $1 million but the relationship exposure under $2 million, then it's the chief credit officer and the CEO together. And then if it's loan amounts over $2 million, then it goes to their loan committee. So that just gives you an example of the different kinds of matrices that can be developed. But here's another example. Another example is that all loans go to your loan committee. Boom, that's it. Another example might be that staff has the ability to approve up to a small dollar amount, maybe $100,000. But what are the considerations you want to take into account when you're writing this this element, is how many people do you want to approve a loan. And I would encourage you never to allow just one person to have loan authority. It's just always good checks and balances that at least takes 2 signatures. The third consideration is what do you want to have approved by loan committee, and again what will stay at staff level versus loan committee, and then what must go to the board. There are a lot of CDFIs where ultimate loan authority rests with the loan committee unless there's an exception, and if there's an exception it goes to the board. Great, we just got a question from one of our webinar attendees and said, do we have example loan policies that can be shared with the CDFIs? And so what we have today in this presentation is not full policies. We have pieces of policies, the outline of elements, and some table of contents. But later, by midsummer, there is going to be a resource bank that is developed in conjunction with the CDFI fund and CARSI and NeighborWorks, and these documents will be there for you to access. And I think that's going to be a great resource for all of us. All right, let's move on to element number 3, the lines of responsibility for making assignments and reporting information within the lending division. And this one is one that you might not typically always think of, but you should have something in there. Remember, your loan policies serve in some ways as a training manual for your new lenders. So yes, they're going to be learning things from you, but also they're going to be using this as a reference document. So it might be that loan applications are taken by individual lenders or assigned by the chief lending officer. You might be a CDFI that has a database, your loan servicing software, or a separate database where your lenders have to enter information about the loans into that database. So is that required? So you might put that in your loan policies. Entering a written summary of any visit with a prospect goes into the database and is responsibility of the lender. Or is each of the lenders responsible for doing upgrades and downgrade memos? That would also go into your loan policies. And that raises a question that you want to think about and also should go in your policies, which is who you do definitely want to answer who is responsible for reviewing your loans on a regular basis for risk rating changes. and if you have a watch list that is regularly presented to loan committee. Not all CDFIs use a watch list, but that is something to think about. All right, this is great. I want to encourage you to keep sending questions. We're getting a number of questions, and I'm trying to answer them as we move along. And for some of those of you who came on a little later, we will be sending out a copy of the PowerPoint to everybody by Monday morning. All right, element 4, operating procedures for soliciting, reviewing, evaluating, and making decisions on the loan applications. This is where you put your underwriting criteria. You might want to put general criteria about the size and complexity of loans, the purpose and source of repayments, borrower's ability to repay. You may decide to get more specific about different loan products you have, about different loan types, real estate, business, single-family mortgage, multi-family construction lending. So this is where you would put that information. And you also might want to have a category about borrower eligibility criteria. This is where the area where you would put if you're going to have a minimum loan to value or debt cover ratio, or how long a business has to have been in existence before you'll consider it for a loan. This is that section. And one of the questions that we ask here is, do you score your loans when you, well, I'm going to save that for later. Excuse me, I'm going to save that for later. Okay, but I think the key question here is, do you have different underwriting criteria for different loan products, and is that delineated in your loan policies? All right, great. I'd like to move on to element 5, and if you have a question, go ahead. Somebody just asked about explaining the scoring. Well, there's 2 different kinds of scoring, and then a little later we're going to get into risk scoring of the loans. But there are some loan funds that every time they underwrite a loan, they have a scoring system where they score the loan and they get a number or a letter, and then they turn that into their risk rating. And then there are a number of loan funds that then from that risk rating link it to a loan loss reserve. And we're going to talk in a few minutes more about loan loss reserves and risk ratings, but there are some loan funds that have a scoring matrix to help give a score to the loan. And if you do have that, that should go in your loan policies, and a copy of that detail should be there. Okay, element 5. This says you also need to put in your loan policies what's kept in the credit files. Okay, what is it? What goes in the application? What goes in the credit files? And I think that people have worked in banks. They have this sense of the formality and the kind of the awesomeness of the credit file and how it needs to be respected and it needs to be uniform. But if you didn't come out of a bank background, you might not have had that training. But good credit files are well organized, they're current, and they would include the following information. So here's a good list. It would include correspondence with the borrower, organizational documents, your loan documents, risk rating records, the project pro formas. But the key thing about a credit file that you need to keep in mind is that the credit file, when anybody opens that credit file up from the outside, they should be able to understand how your credit decision was made. How did you get to yes? And that information should be in the credit file. But the considerations to keep in mind are, what system are you going to use? A lot of different loan funds. There are some differences and similarities around file maintenance. Credit files almost everybody has, but some organizations like to have separate monitoring files where the information that comes in after the loan is closed goes into a monitoring file. Other CDFIs put that monitoring information in the credit file. There's not necessarily a right or wrong. One of the things I want to encourage you to think about today is there's not always a right or wrong. What there is you need to decide the way you're going to do it and then do it that way. So the way that you write in your policies, make sure that that's the way you're really doing it. Collateral files are usually separated and need to be stored in a fireproof container. That would include the note, the mortgage, the legal documents. And then there are plenty of folks that keep desk files. And desk files are an informal file that the lender keeps certain information at their desk. It should always be, it should never be anything that's supposed to be in the credit file unless it's a copy. But determining what goes in each is important. You may, you should put at least your credit file information in your loan policies. But another interesting area that's come up more recently is whether to do hard copy files or electronic files. And the use of computers is really changing that. I will just tell you here that, for example, I've worked with one organization where the credit files are still hard copy and a parallel electronic, but the monitoring files are all electronic. It would be interesting to hear from some of you out there if anybody is doing all electronic, where the credit file, the monitoring file, everything is electronic and they've dispensed with hard copy. That would be interesting to hear. All right, I'm getting a lot of questions. We just finished 5 elements of the 12. I'm getting a lot of questions about the scoring matrix. And I do not have an example today to share with you of a scoring matrix. I will make sure that different examples get put into the resource bank this summer. And I will also say that there are many, many, many loan funds that don't use that system. That instead they just use the risk rating system itself. And we're going to get to that in just a minute. I want to stay in order. And so they have definitions of what their different risk ratings are for and then they use that. But we will make sure that we put some of those scoring matrices in the resource bank. Somebody asked about filing of email correspondence with the borrower, and I think that's just a great question. I've gone through credit files recently where every single email correspondence that ever happened was in the file. And I think that it's part of good credit file maintenance that when you first close your loan, the lender goes through all their files, their desk files, and determines what are the key pieces of information that need to go in that credit file. There is a certain amount of information that can be discarded. You know, subsequent course, again, but it is up to each of your organizations to decide. There are certainly organizations that know we want to keep everything. That's just the way we do it. But you need to decide and then share that information with your lender so that everybody's doing it on a consistent manner. And I think key email correspondences where decisions are being made, where people are sharing critical information, you keep those and you put them in your monitoring file or in your credit file under correspondence. But there's certainly others that can be discarded. Somebody else had just talked about a project pro forma because that was one of the things listed in the list of items for a credit file. So the pro forma is usually the word that we use to describe any kind of budget projections. Might be for a piece of real estate, a real estate development. That's usually the word we use around real estate. If you're a business lender, instead you probably would call them projections and not pro forma so much. But the pro forma is basically anything that is talking about what the business or piece of real estate or the project is expected to do. And that's typically what we're lending against. All right, great. I think it's great. I'm loving the questions. I'm trying to move quickly but not too quickly because we have a lot to go through. All right, and it is a Friday afternoon or morning. All right, element number 6. Lines of authority within the CDFI detailing who is responsible for maintaining these credit files. So, okay, we've just established what goes in them, right? But then who really maintains them? And here's some examples right from individual policies. The lender shall be responsible for creating and maintaining the credit file for each loan that's approved and closed. But this also says annually the Chief Credit Officer shall conduct a review of the credit files to ensure completeness. And that's another aspect of good credit file discipline, which is having an annual review of your credit files to make sure they really are complete and thorough. There are documents that come in after the loan closing, and you want to make sure those really did come in and that you have them. There is just natural human error that happens. Things that you thought got into the credit file don't. There is that occasional, hopefully it never happens in your organization, where you go to the lender's desk file and there's the original signed note. You never want that to happen, but I will tell you it has happened in life. And so how do you address those issues and try to make sure that those are not ongoing problems in your organization? I'd be interested in hearing things that other groups do, but one thing that I've seen work consistently, whether it's a regulated entity or unregulated, is a cleanup day. And the cleanup day, you as the manager can decide how you're going to do it. Are you going to let everybody come in jeans on Friday and say they don't have to answer the phone? They can spend all day cleaning up their files and you buy them pizza. There's different ways to do it. Maybe you can arm twist them to come in on a Saturday. But cleaning up files does take time, and you do need to think about how you are going to ensure that it gets focus and attention, because otherwise it is one of those items that will fall to the bottom of the list. Okay, item number 7, element 7, guidelines for taking, evaluating, perfecting loan collateral. And this is an interesting area because collateral and appraisals this is an area where we really the unregulated CDFIs differentiate themselves from the regulated lending institutions, because we can really be more flexible in our security and collateral requirements. So this organization has up front, they basically are saying we require an unconditional repayment guarantee for all loans. Basically, whether you're a for-profit or non-profit, you have to stand behind your loan. Clearly, there's exceptions to that where certain government programs don't allow it, but where they're saying where it does, where it can happen, it happens. And then here's a detailed example about how this is a particular CDFI, how they look at appraisals. And so here's the statement right up front. In the case of real property, the fund requires an appraisal. But we recognize that a fully documented current MAI appraisal is beyond the financial capacity of most of the fund's borrowers. And so an appraisal document acceptable to the fund shall be required. But then they list, here's some other types of appraisals or substitutes that we might accept. We might accept a letter of appraisal updating a previously completed full appraisal. We might accept a letter of opinion of value by a licensed real estate broker. Or we might accept a form appraisal that is not actually done by NAI. You have to decide what your underwriting criteria are. The interesting thing to note about us as CDFIs is sometimes we work in communities and neighborhoods where we really have, we are more knowledgeable than the appraisers. We are more knowledgeable than a lot of people about what's going on in our markets. And so sometimes we will work, if there's a broker that we think has really good information and we can do some kind of analysis in conjunction with that broker, we might accept that. But you need to talk about that in your loan policies. This is also, here's an example where a lender said for loans up to and including $100,000, the staff can prepare a collateral evaluation. We'll accept that. And then they made a statement that said, unsecured loans will be considered. They will be considered. So just because we talk about collateral, we will consider an unsecured loan. There is a lot of buzz these days, not just among us and CDFI lenders, probably less among us, but in the general public about appraisals. Are they really worth anything? I think the recent housing debacle, whatever we call it, has really put appraisers' kind of credibility in question for a lot of people. But yes, appraisals are still part of the standard real estate lending process. They can still be quite problematic in certain of our markets. And again, that's why we want to think about what we know about our markets and how we want our policies to read. All right. The only other thing I want to say about this is that there are exceptions. you might have a loan to value given in your loan policies, and occasionally you'll exceed that loan to value. So you need to talk in your loan policies about what the process is for that. Does it go to the board? That kind of thing. So what is an exception, and then who can approve the exception? And then somebody should be tracking exceptions also. All right, element 8. And again, the questions are coming, and we like that, so I want to encourage you to keep typing in those questions. Element 8, establish a risk rating system and loan loss reserves. So a risk rating system allows a CDFI to classify its loan portfolio by different levels of risk. Risk is determined by criteria associated with the loan, such as payment history, previous history of borrowing with that fund, loan to value, cash flow, and external factor, among others. A CDFI, you may start with a system, a risk rating system that mirrors another CDFI, i.e. you borrowed or copied somebody else's. There's nothing wrong with that. As long as they're doing the kind of lending you're doing, there's no perfect risk rating system. But there are some that have been used for a number of years and people have found useful. So, but then as you work with your portfolio, you know your market, you might want to revise that risk rating system with experience. And then many, but not all, loan funds, or I should link whatever the risk rating is to an automatic loan loss reserve amount. And I would like to actually take another poll right now and ask you out there if you currently link your risk ratings with your loan loss reserves. So if you could take a few seconds to do that poll. Somebody asked, does a credit score go into a risk rating? Absolutely, absolutely. So if you're a single-family mortgage lender, credit score is a key aspect of your underwriting, and that would be part of your risk rating. All right, we'll close that poll in just 5 seconds, but I appreciate you answering, and it's great. Here's an example of a risk rating system. It's numbered 1 to 5. And 1 is the best loan, and 5 is the worst. And they've labeled these moderate risk, average risk, substantial risk. And you see right away, I mean, I think I can already hear some of you say, well, isn't moderate and average paying? Well, those aren't even good labels. These are the kinds of conversations and arguments you can get in establishing your risk rating. Come up with the words that that you like and that represent what the kind of risk you think you're taking, and then go from there. And there are risk rating systems that have 6, 7, and 8 categories, and I am hearing increasingly from people that are liking categories a little more than 5 because it allows them to tease out more differences in the kind of 3 and 4 area. But for example, this one, but there's still plenty of loan funds that just use 5, and that can work too. By the way, you might be able to see this, but about 30% of you do link your loss reserve with your risk rating, but more of you don't. So it's not something that has to be done, but it is a way to think about managing your risk. So the other thing to note about this example is that for this loan fund, all new loans would be booked 1 to 3. You would never book a new loan at a 4. So to get to a 4 or 5, the loan has to migrate there. So, and that's true of all risk rating systems. There's always, you're going to say, okay, we'll book loans at 1 to 3, or if it has 8 numbers, maybe you'll do 1 to 4. And then the rest is, the loan is not performing as you expected. This is just an example of a grid that links the risk rating to the reserves. So this would be how that might work. This was, I can tell you that this particular example came out of a real estate lender, and but it is a real example. So the questions are, how about that? We just got a question from the audience about how often do you review risk ratings, and there it is. That's a consideration. So how often do you want to review your risk ratings? There are a lot of organizations that ask the lenders to think about it on a quarterly basis, or at least the chief lending officer should be thinking about, is there any new information that you have that would dictate the need to raise or lower the risk rating? And whose responsibility is it? Again, that needs to be stated in your loan policies. Is it the lender or is it the chief lending officer? And then also the question about, do you want to link your loan reserve to your risk rating? You don't have to, but you can. But if you don't, how often are you recalculating your reserve? And whatever you're doing on your reserve, you would probably want to mirror that for your risk ratings in terms of how often. The idea is that you're keeping a close pulse, keeping close to your portfolio, and particularly in these economic times, I would think that quarterly would make sense. All right, take a breath here and move into element 9. This says, hey, make sure that when you do your loan policies, you tell us about your rates and terms. But I want to caution, you don't actually put your rates in your loan policies, or you'd have to change your loan policies every time your rates change. But you want to say how they're established. So here are two different examples from two different funds. Interest rates will be established and reviewed at each loan committee meeting by the loan committee members. The CFO is responsible for submitting the following information before each meeting. It includes what other lenders are lending at, the cost of funds of this loan fund, and the budgeted interest rate spread. So that loan fund is doing it every loan committee meeting. I also know loan funds that do it occasionally. And then here's a loan fund that says the CEO shall establish interest rates and fees. It doesn't say how often. I would encourage you to say how often and who. And then you want to make sure you are reviewing that occasionally. The next element is element 10. And this is starting to get at managing risk of the whole portfolio as opposed to individual loans. And loan policies do that. They get at the risk of individual loans, but they also help you think about your portfolio from a more macro level. And this is saying, for example, you might have this in your loan policies. In order to reduce risks in its portfolio resulting from various potential concentrations, this CDFI establishes the following. We won't lend more than 15% of our lending capital to any one borrower. We won't lend more than 25% of our lending capital to any one type of business, i.e. charter schools, i.e. restaurants, i.e. startups, whatever your borrower base is. We won't lend more than a third of our portfolio, even though it's secured, but secured by vacant land. We don't want more than 35% of our portfolio in unsecured loans. The rest has to be secured. We don't want, if it's a lender who lends in multi-geographic areas, we don't want more than 25% of our portfolio in one geographic area. You have to decide what the right percents are for your portfolio and your market, but the idea is that you start thinking about, there probably should be limits. Even though each of those individual loans is really strong, there still is this concept in risk management that, do we want to have all of our loans dependent on CDBG funding to take them out, now knowing, for example, that CDBG funding is getting cut drastically by Congress. So you might want to think about it, that way. It just gives you a guideline and helps you manage risk. Again, there's always exceptions. But a key question to ask here, and I want to point this out, is we said as a percent of lending capital, and so the question is, how do you define lending capital? And just like in a lot of our work, the answer is it depends. The lending capital could be your borrowed capital, or it could be your borrowed capital, and it says equity here, but what I really want to define it as is your borrowed capital and your net assets available for lending, which is a bigger number, or it could be your loans outstanding, which would typically be the smallest number. And so there's ways to look at your percent of lending capital from a more conservative standpoint and a more generous standpoint, and you need to think about what makes sense for your organization. Typically, we see it against borrowed capital or borrowed capital plus net assets available for lending. I would also recommend that you put a clause in your loan policies that says, if you're going to do these limits, CDFI may reconsider these limits from time to time due to product performance or growth in capital available for lending or other pertinent factors. Okay. I'm looking at a question here. Do you have examples of models which assess and price risk as part of loan pricing? So it is my experience that CDFIs, that we're different typically. I mean, a lot of CDFI are moving more to risk-based pricing, but the whole CDFI movement in a way got started because we weren't risk-based pricers. We basically said, you mainstream lending lenders, you think there's a lot of risk out there, and so you're not even making these loans. And we are going to go out and make these loans and show you that not only is there less risk, but we can make them, you know, we're going to get paid back. And ever since then, I think we have not, you know, community development finance is not standard finance. So I think examples of models which assess price risk as part of loan pricing, every business school in America has that model. And so you can find them out there. But I think that we have more moved towards looking at pricing also based on our cost of funds, whether we're going to do fixed or variable. And certainly I see differentiations between, there are plenty of lenders who, most business lenders charge more than real estate lenders. Most working capital loans are higher than a fixed rate real estate mortgage loan. Most construction loans, but not all, are priced a little bit higher than the fixed rate mortgage part, although that's not always true. So, you know, this is part of kind of who we are, is we're here to help provide capital for those that don't always get it, and we haven't always moved to the maximum of the standard risk price model. All right. Element 11 out of 12, so we're almost there. A description of the CDFI's principal trade area from which most loans should come. This basically says, remember to tell us where you're lending. So you might say, you might be a CDFI that says, all of our borrowers must live in one of these 3 counties in our state. Or you might be a large national lender, and you might say loans are generated on a national basis through our local offices and affiliates. But whatever it is, you need to tell us and put that in your loan policies. And then what are the considerations? Well, how will you allow exceptions? So is that something that needs to go to your board or outside of the normal chain of approval? Will you follow an existing customer outside your geographic area? That's often where you see the exception happen. And then how will you track and report exceptions? Okay. And now the 12th element. The 12th element is a large element, and it's an element that I think probably all of us have become more familiar with over the last 24 months. And that is a discussion of the preferred procedures for detecting, analyzing, and working out your problem loan situations. So your loan policies do need to have a section where it talks about collections and also workouts. Again, you might want to have a more detailed policy manual that gets into all the details and talks about how your loan servicing software works for workouts and things like that. But your loan policies do need to address some of the key elements. So this is an example taken right from a CDFI. This is about a delinquent loan. This is just one piece. If by the 90th day no payment's been received, the loan committee will examine the situation based upon a detailed account of the borrower's operational information and review of the collateral. The loan committee will develop a strategy for action based on or including, it could include any of these options: loan restructuring, strategy to liquidate the collateral, notice of default and the intention to foreclose, a further forbearance of action based upon certainty of repayment, or actually sending the loan to a collection agency, which is not as common because we tend to do our own collections as CDFIs. But the important thing to note about this, because this is where, again, an unregulated CDFI differentiates itself tremendously from a regulated institution, is how we handle our workouts. We have the more discretion than a bank. I just got off the phone yesterday with a borrower of ours who's a social service agency. Her funding is shrinking from the state contract she has, but a large bank is interested in coming in and taking us out and doing some other financing for her. And her board is actually advising her to stay with the CDFI I work for right now because they think they're worried about how harsh the bank might be if they ever had a difficult time. And I actually think that's a pretty astute board. That doesn't mean that we won't foreclose. CDFIs foreclose all the time, and if you go and get this year's audits from a sampling of CDFIs across the country, you'll see a whole lot of real estate owned on the audits that for organizations that never had real estate owned before, because we are foreclosing. But we do have more discretion. We don't have to write the loan off after 90 days. We don't have to do some of the things regulated entities do. So you want to think about that. And here are the considerations when you write this part of your policies. Be specific. Who does your collections? What about extensions versus restructure? Extensions are done all the time, and it doesn't necessarily mean a loan's in trouble. A restructured loan is a loan that has had a change in terms because the borrower could not meet the original terms. And when do you start foreclosure? When do you charge off delinquent loans? Have you built in the flexibility you might need? You might decide to be very specific in your policies. You might want to leave yourself a little wiggle room. But who has the authority to make the decision about next steps? That should be stated in there so that you know who does make the decision. And then what reports does the board see regularly to help them stay current with the problem loans? And I want to encourage you, you always to do that regularly, because you don't want your board to have a big disconnect between a deteriorating portfolio and the last report they saw. So you want to make sure that your board is getting regular reports. Whew. Okay, that was the 12 elements. We do have one more section to go over, but I want to take a second again, catch our breath, and one last poll. Again, this one helps me know a little bit more about you, and that is what region of the country you're from. And so if you would just take a minute again and fill out this poll, and then we'll share those results with you after the poll closes. We'll just take a couple seconds here. So the next piece that I want to talk about that is not included in that FDIC document, which we drew those 12 elements from, because these are functions that are not normally discussed in the loan policies. However, they're an important component of overall risk management and keeping your portfolio in good shape. And that's what I want to include them today because it fits in with the topic. And I'm calling them lending control functions, and they are audit functions, loan review, and portfolio review. And so I just want to take a little bit of time to talk about these. So these are 3 tools that you can use for your portfolio to have what is typically outside eyes come in and assess your portfolio in a way that you don't, because you're inside eyes. The first is audit function. Pretty much probably everybody gets audits, and this is not considered a comprehensive review by any means, but you should find out, is your auditor reviewing your credit files? Are they typically, auditors will pull a random sample of credit files, but you need to ask them what they're looking for. And I would also ask them for their results, just as a little internal feedback. The different auditors do it a little differently. They might just be looking to make sure that the amount on the note matches the amount that's in your accounting system, or they might be looking for something a little bit more related to credit risk. So find out and use that as information for self-evaluation. The loan review is a different kind of process, and this is when you go and do a deeper dive of your individual loans at a moment in time. And the idea here is that you stop and say, okay, as of December 31, 2010, we're going to say this was all the loans that were in our portfolio, and now we're going to go in and assess how each of these loans are doing. You say, well, you did that when you first underwrote them, but maybe you underwrote them and booked them 18 months ago or 24 months ago or 36 months ago. So how is it doing now? Yes, you do risk rate occasionally and think about the risk rating, but this is about doing a deeper dive. Sometimes the sampling is done, but sometimes the whole portfolio is done. This could be done by your loan officers themselves, or this could be done by an outside party. Basically, the goal is to assess the individual loans, to determine the compliance with your loan policies. They could be good loans, but if they're not in compliance with your loan policies, you're going to get a ding. They identify lapses in documentation, and also to reevaluate the risk rating. And I would encourage all of you to think about a loan review at some point. I know of loan funds that went 20 years without their first loan review, and I know loan funds that do this every year. But it might, depending on what your average term of loan is, what your staffing capacity is, what your budget is, maybe you could do a loan review every 24 months, and maybe it's done by your staff. Or maybe you can bring in an outside organization or consultant to do this. Just got a question back to the audit element, which was, is there a standard way loan funds are audited and reported? And my answer to that would be GAAP. So your auditors are certifying that your audits are done according to GAAP, but you still see different formats used. And I've looked at audits from probably 50 loan funds, and there's similarities, but there's always a few differences. Okay, so loan review, again, that's where you're looking at each individual loan, and then portfolio review, which can sometimes come out of your loan review, but a portfolio review aggregates your data at the portfolio basis. And there's actually two really good guidances, publications that OFN has on each of these that they have, and talks about loan review and portfolio review. But the idea around portfolio review is that you aggregate data and then slice it and dice it to look at different concentrations. So this relates back to your concentration criteria, where you'll say, how many loans do we have that are secured by second mortgages? How many loans do we have that are to charter schools versus health clinics? How many loans do we have, whatever? And you want to measure your portfolio on aggregate basis against your defined portfolio limits. And it's a very interesting way to look at portfolio, and it's a key component of managing risk at the aggregate level. The considerations when you do a loan review or a portfolio review is the frequency and who does the work. And I just want to say, a loan review, these are labor-intensive efforts, very labor-intensive. And so I was with one organization where when we did a loan review and we used internal staff, they basically, for a week, really didn't process any existing loans. I mean, work kind of had to stop a little bit. I mean, that's pretty drastic, but I just want to say you need to consider the impact on staff and workflow when you do these and balance all that, but it is an important tool. Somebody's asking about, I mentioned loan software, and so somebody is asking about vendors for loan software for a small nonprofit, I guess CDFI. So There are a number of software vendors out there for the CDFI world now. There's at least 6 that I know of. They all regularly exhibit, I know, at the OFN conference. I think we'll probably put something in the resource bank about that. But you can email me after this session if you want, and I can share with you some of the vendors. There's Nortrich, there's Portfol, there's TEA. There's a number out there. And then there's a number that are more geared towards small business that I'm not as familiar with. Okay, we are just about done. We have handled the 12 elements. We have talked about loan control functions. And I just want to show you when we talked about those 12 elements, this is a sample table of contents. This table of contents, you can see, has 16 different headings and then attachments. I'm looking at the top of this, underwriting standards for for-profit borrowers, because before that one is underwriting standards. That would be for the nonprofits. There's your risk rating classifications. These loan policies have a sample appraisal engagement letter included in them. Here's another sample table of contents. This one shows where it says Loan Committee Special Program 1, Loan Committee Special Program 2. Those are 2 different types of loan programs they run. They have different criteria and different ways of managing the risk of those products. So that's just to give you an example and something to think about. The concluding thoughts I want to share with you for loan policies and procedures are that, one, I want to thank you for staying with me for this webinar because it's a lot of information. But 2, what I want you to know is that even revisions, they can take a long time. And you can see how you can delve into some of these issues and you can chew on them and go back and forth and have little arguments on your staff about which way to do it. And so I just want to say, give up on perfection and aim for prudent, clear, and policies that are representative of what you're doing, as long as what you're doing is sound lending. Now, if you're not doing good lending, then then tighten up your policies. But give up on perfection. Aim for prudent, clear, and representative of what you're doing. And you need to think about your own organization's dynamics. Maybe you have the kind of board that doesn't like to see anything except very high-level information, and so they want to delegate everything to the loan committee, and that's fine. Then maybe only exceptions would go to the board. Maybe you have the opposite kind of organization. Maybe your loan committee is your board, and so everything goes to your board. You have to look at your organization, its history, the people involved, where the expertise lies, the lending expertise lies that you want to access, the risk management expertise. And then you need to think about your loan policies that they work together in a way like underwriting works together. For example, in underwriting, if you're going to take a startup developer, I'm going to use real estate example, startup developer, you go up to 100% loan to value. It can be a debt cover of 1.05. I mean, I'm using examples that are like the most generous of everything. You don't want to have loan policies that are everything is very generous. You probably don't want to have loan policies where everything is very strict. You'll never do a loan. You want to think about how your loan policies are working together to get you to the place that represents what the level of risk your organization is willing to take and the type of loans and lending it wants to do. And lastly, I just like to remind you that your policies are really only as good as your practices. And they're not written to sit on a shelf. Your loan policies should be handed to every new employee as they walk in the door. They are the reference and referral manual. And you do want to keep them fresh. So like I say, look at them once a year and make sure that they're representing what you're doing. Any questions? I can take a few more questions. Feel free to type in. Otherwise, I want to share with you again that this presentation that is the first in what's going to be a series of 4 webinars held over the next few months. You can see the other titles. They're all part of the CDFI Fund's Capacity Building Initiative. And you can register at this link, which we will send you, if you're interested. The sample documents I talked about are going to be available at the Resource Bank this summer. That bank is being put together as we speak, and so you can stay tuned to its opening on the CDFI Fund website. And I just would like to say thank you very much. And the other thing I want to bring your attention to is that the two experts that we have for you to reach out to for TA, Jack and Eric are their names. Their emails are also here. And I thought I had a slide here. Oh, there it is. You can also feel free to email me at faustk@pcg.